What have you made of the session so far, Tim?
There's a few sectors that are standing out really well today, actually. If you look in the healthcare space, performing very well, diversified financials doing well, staples, energies, etc. But we just saw some of the heavyweights sort of weighing on the market during trade today. It's actually been a very narrow trading range. After sort of the first hour of trade, the market sort of only traded within sort of 10 points or so since 11 a.m. But we're just starting to see a couple of the big banks move into positive territory. They were the major weight on the market. During the morning, big four banks down around 0.5%, while BHP and Rio and the gold sector as well in the mining space was the other weight on the market. And really what we are seeing today is some of the Aussie dollar leveraged and US growth leveraged stocks doing particularly well. During trade this morning, you saw the Aussie dollar hit a new 32-month low, traded as low as 93.83 US cents. It's come back up above that 94 level again now. But if you look across the market, healthcare very leveraged to the Aussie dollar, doing very well, up 2.5%. Macquarie Group, News Corp, some of those other stocks, Aristocrat Leisure, all doing pretty well, up 2 and 3% today. And I think really what we're seeing is that companies with leverage towards the US market are going to probably continue to outperform. We've seen a note come out from Goldman Sachs today saying that the risks to the Australian economy are rising at the moment, while the US economy, if you look at the data that comes out there, continues to impress the market mostly. And I think that's reflected year to date in what we've seen in equity markets. The S&P 500 is up 15% in 2013, but if we look at the ASX 200, it's managed only a 2% gain for the year to date. So I think with a lower Aussie dollar and as the US economy improves, we'll continue to see a bit of a theme of those particular stocks performing well on the market.
You mentioned healthcare doing reasonably well. One of the leaders there, Ramsay Health Care, new acquisition, seeing their shares up about 2.5% at the moment.
Yeah, doing well today. The private hospital operator, it's purchased another French hospital, Clinique de La Union. Sorry, my French pronunciation isn't very good.
That was terrible.
That company, yeah, pushing their international growth strategy. I mean, we've recently seen them announce a 50-50 joint venture with Sime Darby in Malaysia to push the healthcare growth in the Asian region, where there seems to be significant opportunities. But looking at this French acquisition, it's actually Ramsay Santé's second acquisition since Ramsay Health Care took a majority stake in that in 2010. And if we look across Europe, they do have quite a significant presence in Europe, Ramsay Health Care. This will make it the 11th French hospital they now operate, and they operate at around another 38 hospitals in the UK. So if we look at the European business for Ramsay, it hasn't performed all that well. Within the UK, revenue growth has been pretty subdued, and so has earnings growth. And in France, the tough operating conditions that they have seen probably expected to continue for a little while. But overall, I think Ramsay Health Care looks pretty, not fairly well valued at the moment. I mean, looking just at PEs, it's sort of trading up around 26 times 2013 earnings, which is quite a significant premium to the broader market, but more significantly, it's also a premium to the broader healthcare sector on the ASX. If you compare it against, say, your Cochlears and your CSLs, which are around 20 and 23 times, 26 times is a bit of a premium. So I think given the fact that it is looking to grow its operations worldwide, that's why the market's giving it this premium over other healthcare players. But, you know, after a 60% run in this share price year on year, it's looking pretty valued, so pretty fully valued. So we could be in for a little bit of consolidation with Ramsay Health Care.
Well, at the other end of the spectrum, if Ramsay's doing well, the other end is NRW Holdings, earnings downgrade, just the latest in a litany of mining services, albeit they're off the lows of the day, down just 8 and odds %.
Yeah, that's right. They've come out and said that revenues for FY13 are going to be 1.3 billion now. That's up to 13% lower than what they had in terms of guidance previously. While if we look at their net profits, expected to come in 73 to 76 million, which is down as much as 20% on what we saw through FY 2012. And they've blamed contract delays and project referrals. We also saw NAB's business confidence read come out today, and mining capex hitting sort of 11-year lows, sort of feeding into this story we've seen in terms of mining services downgrades. But I think what this shows is it's a little bit difficult to tell how much bad news and negativity is priced into a stock, and how hard it is to pick the bottom of an earnings cycle. Because a couple of months ago, after a significant fall in NRW's share price, if we look from the peak sort of 2012 through to a one-year period, it's sort of down around 65% or something like that. And since April, it's sort of fallen even more now. And I think around April, there was some feeling that a lot of the negativity and possibility of another earnings downgrade was already priced into the stock, but now the stock's fallen another 30%, including a 9% fall today. So it just shows how difficult to tell it is, how much is priced in. I mean, you look at NRW, it did look like one of the more attractive mining services type players in the small cap space, largely because it was a little bit more diversified than a lot of the other players. It's got a large civil engineering business, which is actually the largest earner for the business, makes up around 60 or more than 60% of its earnings, but mining services does make up around 40% of revenues and earnings. So the lower capital expenditure from the mining companies will hit mining services, and NRW wasn't able to avoid that either.
No, indeed. Look, Tim, as always.